Can you give me a bigger picture here, how the flow changed from the 30s and 40s up to the 50s and 60s? Can you tell me the story of how it changed, and then we can go into some.
Well, if you go in the 1930s, initially the income tax didn't affect a large share of the population, right? It was really only with World War II that you got a large share of the population included in the income tax that were having to pay income taxes. And coming out of World War II, the marginal tax rates were quite high. And when President Kennedy took office, the highest tax bracket was paying a marginal tax rate of 90%, which sounds astounding, right?
90%, so someone that was earning over what? Over
I don't recall. Off the top of my head, I don't recall what the income threshold was.
90% of their income, the taxes?
The marginal rate was 90%.
Explain the marginal rate.
Okay, if you earn $1 more of income, how much is the government going to take? Okay. On ordinary income, the marginal rate was 90%. There were preferential rates for capital gains and things, though, too. So, I mean, it's not like
gains is
if you buy an asset and then sell it for more than you bought it for, whether it's stock or real estate or whatever, that's a capital gain. And that, for much of this history, capital gains were taxed at lower rates than ordinary income, which
and still is today, somewhat, right?
That's true today too. There, you know, so the rich weren't paying 90%. Rich get a lot of income from capital gains. So the rich weren't paying 90% of their total income in taxes. But at the margin, on ordinary income, wages, salaries, or dividends, they were paying 90%.
Okay, so if they receive a salary from a corporation that maybe they owned, or So
Kennedy cut those marginal tax rates from 90 to 70%. Okay. Then in terms of the policy developments, with the Reagan Revolution and the supply-siders' influence, in the first part of the Reagan administration, the top marginal tax rate was cut from 70 to 50%.
When was this?
This would have been 1981.
Okay.
The legislation would have passed.
From what to?
From 70% to 50%.
Okay.
But then, you know, but that was a tax cut. That is, the total revenues the government was collecting were cut by those first Reagan tax cuts.
What happened in the 70s? I want to get before going to the 80s, what really happened between the Kennedy era and the Reagan era? Really,
the only big significant development during the 70s was when the Earned Income Tax Credit was first introduced. The Earned Income Tax Credit is something that actually supplements the income of the working poor. Instead of paying taxes on their earnings, they actually get a rebate. And it can be used to offset other tax liabilities, but if they have no other tax liabilities, they actually get the money.
So the lowest income earners, they don't pay much in other taxes, but they do pay in Social Security taxes.
Other federal taxes.
Right, right.
Okay.
So what really set the stage for the problems that Reagan in the 80s inherited? And what did they do? What was the supply side ideas to change it? Okay,
so the Carter era was famously described by Carter himself with the word malaise.
And that thought was, if you increase the cost of things, then my company, when we sell things, we take in more money and we can keep growing. So how would you describe what that really amounts to?
Well, no, it's not that. It's the demand for the products pulls the prices up. It's not a cost push kind of thing. It's growing demand for products will cause prices to rise, and that feeds back into then higher prices for the inputs.
The Keynesian model, the increase of aggregate demand, the demand of the buyers, the consumers, that will increase prices. And then you're saying the consequence of that would be what? Inflation?
Yes.
Okay. So everything expands, everything increases.
Right.
Okay.
So the supply-siders had a different view. They were looking at tax policy and tax cuts not as a way to increase demand, In the Keynesian view, if you cut taxes, you're giving consumers more income to spend, and that's going to increase demand. But the supply-siders were looking at it from the perspective of you cut tax rates in order to increase incentives for people to work and invest. That increases the productive capacity and increases supply, so you can have output growing and actually be putting downward pressure on prices. Okay.
Okay.
So, but then where the supply side policy was not actually so successful in the early Reagan administration was at the we had this very high rate of inflation. So that at the same time the supply siders were cutting tax rates, the Federal Reserve was pursuing a restrictive monetary policy that was reducing aggregate demand and was very successful in reducing inflation, but caused two relatively short recessions early in the Reagan administration.
Okay, so prior to 86, capital gains was treated differently then. Okay, and 86 changed
that. With the 1986 tax reforms, capital gains were taxed at the same rates as ordinary income. Okay. But the idea was that the marginal tax rates were reduced from 50% supposedly to 28%.
Okay. So that set the stage for the Reagan era, and that was a change for the first Bush and Clinton era. What really happened after Clinton and with Bush?
For one thing, the government was running budget surpluses before we went to war in Iraq and Afghanistan. Part of the reason the tax rates had gone up during the Clinton era was trying to reduce budget deficits, right? So there wasn't that deficit pressure, concern with the deficit pressure that was keeping tax rates high. So the Bush administration introduced cuts in tax rates on the personal income tax across the board, getting the top rates kind of back down to where they were, not all the way down to what they were at the end of the Reagan administration, but lower than they had been in the Clinton era. And also lowering the marginal tax rates at the very bottom of the income distribution. So a lot, and this is where we've gotten to the situation where a large share of our population pays little or no income tax. Social Security tax is really the big part as far as federal taxes. Social Security tax is the biggest part of many households' tax burden. But the other part of the Bush cuts was a desire to address this problem that we call the double taxation of corporate source income.
Makes sense, yeah.
Because it's encouraging people to put money in this particular kind of an account. I can transfer money, from, in fact I have transferred money from investments that I'd already made into an IRA. I haven't saved anything, but I reduced my taxes. That's not providing a saving incentive. So you need to do these things comprehensively. You do these kind of mishmash hybrid things, and they don't provide good incentives. They're not following any principle, either of income taxation or consumption tax. And they don't provide much in the way of incentives. They provide a lot in the way of loopholes for people who want to game the system.
So say again, what was his goal? His goal was to...
Well, the reason to reduce taxation on the double taxation of corporate source income is kind of two things. One is to encourage more investment in the corporate sector. Okay. The other is that there's part of corporate source income that is not subject to double taxation, and that is corporations, in calculating their taxable profits, get to deduct interest payments on their debt. And so the existing corporate tax, because it doesn't impose a double tax burden on debt-financed investments, is favoring debt financing, encourages corporations to use debt financing rather than equity financing for their investments. And so that's a criticism that's kind of widely shared among economists.